Natural gas prices have bounced to begin the new year after a significant sell-off to end 2023. So in this video, we're going to run through the factors driving prices right now and take a look at the technicals of natural gas. Before we push ahead though, of course, remember to like and comment on this video. We'll be sure to get back to you. We want to hear your views on what you expect to see from natural gas markets in 2024. Natural gas prices slid to end 2023 largely due to ample supply across the globe, as well as some demand-side concerns as economic activity slowed. But to begin 2024, we've seen a bounce back in natural gas prices. In fact, this week, a 5% surge on Wednesday, really as the outlook for European weather starts to shift. Now, last year, there was the expectation that weather would be fairly moderate in the winter time in Europe. However, it would appear, based on current meteorological forecasts, that there is a looming cold snap coming in Europe, which ought to drive demand for natural gas, obviously, as households seek to heat themselves. So that's pushed natural gas off its lows and is also conspiring with some other supply-side risks to push prices higher. Namely, that is the tensions that we're seeing in the Middle East and in particular the Red Sea. Now, of course, the tensions in the Middle East tend to impact oil prices a little bit more, but there is a twofold impact of what we're seeing at the moment, especially in the Red Sea. One, it's clearly the spillover effects of what's happening in oil markets that tends to have a put upward pressure, I should say, on broader energy prices, including natural gas. But there is also the fear around freight lines in particular, and the risk that freighters carrying natural gas could either be diverted or interrupted by what has been Houthi attacks in the Red Sea that have, recently been tried to be deterred by Western powers, especially in the United States. Now, around 12% of global commerce goes through or global trade goes through the Red Sea. And in fact, around 4 to 8% of natural gas trade happens through the Red Sea at some point in time. So what we're seeing now at the moment is a lot of freight companies, Maersk, for example, rerouting a lot of their container ships away from the Red Sea through longer voyages to get to their a final destination, which is putting upward pressure on costs. And again, there's that risk premium being built in on the basis that perhaps greater conflict in the region, especially around that Red Sea area, if the Houthis continue their attack on freight trips. And of course, this is in response to the Israel and Hamas conflict, that we will see a major disruption to global supply. That also adds to some of the demand side factors that we've been seeing recently, maybe signs of resilient growth in the United States as well. In the longer run, though, there is still the downside risk emerging to natural gas prices, stripping out some of the supply side concerns from deteriorating economic conditions across the globe. And if you do look at things like the Bloomberg Commodity Index, we have seen things like, oil prices, as well as other industrial metals, trend lower really as the markets assume a weaker economic outlook for the year ahead. The other potential headwind for natural gas prices, and which could lead to some level of stabilization in the short term, is still the fact that although we're expecting to see, or meteorologists are expecting to see, this cold snap go through Europe, storage levels in Europe remain historically high and certainly beyond their 5-year averages. So data cited by Reuters recently suggested that the storage levels in Europe are still around 86%. That's above the longer-term average of around 74%. So storage capacity is still very high, and it would seem Europe is still in the position to be able to absorb shocks. So a lot of this upward pressure that we're seeing on natural gas prices appear to be from a supply shock perspective, so something exogenous to the market, and driven by seasonal factors, which tend to be a little bit more short-term in their impact on prices rather than those longer-term issues around storage, supply, and global demand. So let's run through some of the key technical indicators for natural gas, and you can see that we've got the market bouncing from extremely oversold levels on the daily charts and breaking through downward sloping trend line resistance, indicating this is a little bit of a reversion and retracement going on for the market. In saying that though, the price pattern being carved out for the market is looking a little bit like a continuation pattern, an ascending wedge, which typically signals that this move is counter trend in nature and that something of a breakdown of this move is on the cards, more than likely posing further downside risks for natural gas. In terms of the major support levels, well, $2.20 is the most previous lower low for the market. A really deep level of support is around $2, which has been defended by buyers in the past. But on the upside, we've got the 200-day moving average around $2.80. Above that $3 stands as a very key level to watch, with the price not spending too much time above that point in the last couple of years. So overall, the technicals still look a little bearish for the market, and this move looks a little bit like a retracement and a reversion to the mean. But of course, any breakout through those key resistance levels could negate that view. So in the short term, the fundamentals are looking constructive for natural gas. The technicals are reasonably questionable, as we noted, and in the long run, there still seems to be significant headwinds to natural gas prices. But nevertheless, we'll see if the market can push things or push the price of natural gas above that $3 mark. Again, could be fairly bullish in the longer run, though. That $2 level seems to be where buyers have been defending in recent history.